I hate to say I told you so, but I told you so. Crocs stock just went up 14.24% on the back of this earnings, and they were phenomenal. In this video, we're going to talk about in this video why the Crocs stock went up so much, why I continue to own this company. It makes up about 19% of my invested net worth, and why I think it's going to do great moving forward over the next year or two. Now, this is the highlights of the earnings. We're going to go over that in this video. We're also going to talk about both global and domestic penetration across the globe. We're going to talk about this company's margins, which didn't show up very positive. I don't like this part of the earnings report, but overall they're growing very fast, and that is a bullet point that I want to hit hard because it is important, but the margins are not doing as good as I'd like. We're going to talk about international growth. We're going to talk about constant currency growth. We're going to talk about the long-term goals for both Crocs and Hey Dude brands. And then we're also going to talk about some other quantitative type things like financial ratios, including operating margins, profit margins, return on capital employed, shares outstanding, cash and debt flows on the balance sheet, and then lots of good stuff like that. It's going to be a fun one. So if you want a quick, broad overview for the company Crocs stock, a stock that many investors and many YouTubers will not talk about, especially since this is a boring $4 billion company that you typically wouldn't think of investing in, that trades at about a 7 forward PE ratio, I think it's one that investors typically overlook. And when the company consistently produces outperforming results, you see big moves up in the stock price like this at 14%. My 200 shares I own almost made me $2,000 today on the back of this earnings report, and overall, I was pretty happy with the results. So if you haven't seen me before, my name is Jordan. I'm a millennial investor. This is my YouTube balance since starting the brokerage back in April of 2020. This is my holdings, which I showed earlier, including the 19% stake in Crocs. We just made a change to this recently, so stay tuned. My performance year to date as of the 1st of November of this year, my monthly YouTube income, and my lifetime YouTube income. My balance as of the time of me filming is $32,975, and here's my performance on the brokerage, so you see that I'm not faking it. It goes straight from my brokerage, which is flowed into this performance chart right here. Now, if you want to see my portfolio holdings, this is shared down below in the description, and you can help support the channel. The way that I help fund this portfolio is through this chart, the monthly YouTube chart. This is backed by the referrals that I get from you guys, and so far we've had 132 people sign up, and you would help get opportunities into a free, awesome brokerage, and you'd help support me in the channel. So without further ado, let's go ahead and dive straight into Crocs. Check out all the stuff down below in the description if you're interested, and let's go ahead and start with the top line revenue. $985 million, which represents 57% revenue growth on a traditional number over number basis, and it would be 63% on a constant currency if we didn't have FX, which is other words foreign exchange headwinds. Now if we click the revenue chart here quarter over quarter, you can see the big ramp up. Now to be fair, a large part of this is due to the Hey Dude acquisition, which brought in hundreds of millions of revenue. But 57% growth is awesome, but it will slow down significantly once this acquisition takes place and we start to see that in the numbers. Now profitability, this is a big one, and we'll come back to this probably 2 or 3 times in the video, but free cash flow did grow year over year, grew 31%, and it came in at a pretty hefty $129 million, which this is the number that I most care about for Crocs. The revenue growth is great. I want to see this number as high as possible. We're reaching almost $1 billion every single quarter now, but this is the number I care about more. I would much rather see this number, free cash flow, which is the profitability, outperform than that of the top line revenue growth. Now you can see that 716 of that million came from the Crocs brand, which grew 14% year over year and 20% on a constant currency basis. 269 came from Hey Dude, which was 87% growth, and these two growth numbers are so important for this reason. The first one is you might think Crocs, being an older company, not growing at all, well they just grew 14% and on a constant currency basis. If you take out the foreign exchange from the stronger dollar, because they sell a lot overseas, they would have actually grown 20%. In terms of Hey Dude, this is the newer kid on the block, the new company that they just bought out. It almost doubled revenue year over year. Absolutely incredible. I think I wouldn't be surprised if the fourth quarter, if they really shock investors and they come out with huge numbers for Black Friday. Now the cool part is that this company is starting to sell not just in the US but across the world, and you can see the pie that's coming from Hey Dude being at 27% is starting to increase. It was lower and now it's getting higher and higher, and I wouldn't be surprised if very soon, a couple years from now, we saw this at 50-50, or even one day maybe Hey Dude Dude actually exceeding Crocs because I think it's going to be a popular shoe brand. Now the margins. The margin did go down, and this is something that I think is a bit concerning. And let's go ahead and pull up the financial metrics. The return on capital employed is down from those pretty high highs of 2021 at around 15, 18% or so. This quarter was 7%, which isn't as good. The margins. The gross margin is down year over year. A year ago in this quarter, they produced 64%. This one was 55. The operating margin. The operating margin came in lower from last year's 32 to this year's 27. And then the profit margin, which I care about probably the most, which came in at 25% last year and came in at only 17 this year. It's from this acquisition. They have a lot of expenses trying to ramp up the smaller Hey Dude brand, but I think they can get it done. In the meantime, unfortunately, they're going to have to incur a lot of costs, and there's also a lot of troubles with inflation and the recession that we're in, but I think that 2023, 2024, I think this will be a big winner. Now, it isn't great to see these operating margins going down, negative 890 basis points, negative 910 basis points, 560, 490, you get the point. But long story short, I think long-term these trends are going to do just fine. Now, they are growing international, which I mentioned earlier, and this company is growing only 2% in North America, and that's really not where the growth is coming from, which goes in line with the FX headwinds. They grew 66% in the Asia Pacific region. 82% on a constant currency. Now, EMEALA grew 26% and 46% on a constant currency, which is absolutely crazy how fast overseas this company is growing. Now, you can see the long-term outlooks. I won't put too much weight on this, but I do want you to see it just so you can see the direction that this company is going. But the main point I want to focus on is the growth of Hey Dude, because you see initial expectation. Towards the beginning of the year in 2022, I think it was 8 months ago, I think they closed in February. So 8-9 months ago, something like that, they closed on Hey Dude, and their initial expectation was achieving revenues of $1 billion in 2024. Now they expect revenues to be over $1 billion in 2023. So they're expecting to meet their goal, exceed their goal, by over a full year earlier than they originally projected, and the operating margins are still going to be awesome because Crocs operating margins is 26%. They're expecting the same thing for Hey Dude to be at a long-term trend in the upwards direction. So overall, how do I feel about this company? Well, the only two things I wanted to go over before I finish and give you my opinion was mostly the shares outstanding in the balance sheet. This company had been buying back shares for a long time, and they are now issuing shares a teeny tiny amount again, and that's for one reason. It's to clean up this balance sheet. Do you see this huge spike up in about $2 billion in debt here? That all came in one quarter from the raising of capital of Hey Dude. They did take a lot of debt on, but this is the good thing I want to see. Ever since they took on that debt, you see that the cash has stayed pretty much flat. It stayed pretty much nowhere these last 3 quarters at the beginning of 2022, but the debt pile is continually going down. It's went from $2.8 billion to $2.69 billion to $2.54 billion. They're paying off that debt very quickly in a short amount of time. So I think in 2022, and especially in 2023 moving forward, as this free cash flow continues to produce hundreds of millions a quarter and hundreds of millions a year, last year they produced $511 million in free cash flow, as you can see from this chart right here, which over doubled year over year. I think that they're going to start paying back that debt very quickly. So the big risk of owning this stock is investing while they have this massive $2 billion plus debt pile, but I think that they'll pay this off quickly. I wouldn't be surprised by the end of 2023. Right now we sit at $2.5 billion. I would say by the end of 2023, if I had to guess, I would say they probably have, of this $2.5 billion, they will probably only have maybe, I don't know, 1.75 left, 1.8 left. I think that they'll be under $2 billion at the end of 2023, and I think that this will put this company in a much healthier financial leverage situation, and then the revenue and the free cash flow coming in every quarter at that time will likely be much, much higher. But do the math, y'all. They're projecting about $10 in EPS year over year. If you look at the earnings per share, they just beat it. They beat top line, they beat bottom line, and they raised their guidance. And with this year, they're expecting to produce $10 in earnings per share, which grew 12.4% year over year. But at the $10, if you divide that by the current share price, even with the big uproar today of $10, if you take 76.6, divide that by about $10, you have a PE ratio of under 8, about 7.6. That is absolutely crazy and so ridiculously cheap considering the type of market we're in, where the average in the market, I believe the last time I checked was around a 16. So it's easy to look at this chart. If we go to the research tab here and we type in the ticker symbol CROX, you might be saying, oh wow, it is up 14% on the day. It must finally had the big uproar that we thought. Well, I would say that it's just getting started because year to date, even with this big uproar, it's still down almost half. It's down 47% year to date, and I think that this company has a lot of room to improve. If there's a chance, if there's one company in my portfolio that would double up, it would be Crocs in the short term. Many of these are long-term compounders, and if you look at my top holdings, Salesforce, a long-term compounder. Amazon, a long-term compounder. Google, a long-term compounder. And these are very big dominant tech companies, and Crocs is not as high quality as these big tech stocks. But because the company is trading so cheap and investors are not realizing how fast the Hey Dude and Crocs brand is growing, that I think if investors start to turn bullish on this company, this is the type of stock, with it only having a $4 billion market cap, this is the type of company where we could look back a year from now and say, holy crap, a year ago it's trading at 76, but now it's trading at $150. This is definitely the type of stock that could potentially double up in just a year or two. It's a small cap company, it's a high growth stock, and it's one that trades at a rock bottom valuation and investors don't pay attention to. So don't be surprised if we see a couple other big quarters and we start breaking $1 billion a quarter if this company rapidly increases in share price. And the coolest part is that when you look short term, if you look over the last several months, in the last 6 months it's down 4%. In the last 3 months it's finally started to have a downturn, and then after today it's actually going to be up if you factor in today's uproar. But over the last 6 months, actually yeah, if you factor in today's uproar, it's actually up over the past 6 months, when meanwhile if you look at the S&P 500 over the last 6 months, it's down 10%. So that's not even counting today's downturn either, which is now over down 10. But you get the point. It's 1 out of 10 on holding throughout 2022 and most of 2023, but it's one that I like for the earnings report. It had some good numbers, and I think it's going to do great moving into the next year. But other than that, guys, that's all I have for you. Check out all the stuff down below in the description, and I'll catch you guys next time.